Startup Investing 101, a session aimed to address the topic of startup investments. To deliver this session, we have with us Mr. Yagnesh Sanghrajka. We welcome you, sir. Mr. Yagnesh is a chartered accountant and has had a long and successful career in the corporate world, having led finance, M&A, strategy, and investor relations for various organizations.
Recording in progress.
Large and medium size, listed and unlisted. Mr. Yagnesh currently is the founder and CFO of 100x VC, India's first SEBI registered venture capital fund, which uses iSafe notes to fund startups. 100x VC has already funded 50 companies till date. Once again, thank you, sir, for joining us today. Before we start the session, I would like to inform the participants that they will not be able to unmute themselves during the session. So kindly use the raise hand option in case you wish to ask any questions, or you can drop in your queries in the chat box. Over to you, sir.
Well, thanks, Anisha, and thank you, PDPU guys, for doing this. And I'm quite excited to talk to the angel investors. I believe we have a lot of angel investors on board. So I'm gonna quickly switch on to my presentation, and while I'll bring up that, and so it's probably I'll keep it to about 45 to 50 minutes so that we have enough time for Q&A. Is that okay, Anisha?
Yes, sir. Yes, sir.
Sure. So please feel free to kind of stop me wherever. It's an exhaustive presentation, so probably a lot of questions that people have will be answered, but I'm welcome questions in between as well. So I'm just going to share my screen now. You guys are able to see my screen?
Yes, sir.
Yeah. Please do let me know if my network is not good, or probably I break up. So I'll continue from where I leave. All right.
Yes, sure, sir.
Sure. Okay. All right. So it's full screen. Yeah. Okay. So welcome again, guys. And this is I've just kind of designed this as a masterclass for early stage investors, those who probably have just started investing in startups or probably wish to invest in startups. So this is a primer, or this is a kind of introduction for early stage investors. Basically, startup investing is all about looking into the future, right? Seeing into the future, as we call it. It's not pretty much what you see in the past, what is current, because the whole game here is to kind of see in the future. That's typically what startup investing is all about. Unlike in equity markets or stock markets, and I'm sure some of you guys are also aware about stock markets. There, a lot of companies are already evolved, and a lot of metrics are important, right? The past and the present, apart from obviously the future. But startup investing is more towards what is not visible right now, what is not visible to the naked eye, what you actually are seeing into the future, what are the trends. Those are things that become important from a startup investing perspective. So just giving you an example, guys, I mean, first let's talk about what kind of rewards are there in this business. Why is it that so many people nowadays, are considering startup investing? So, just a small example. How big is a small bet, right? You would put in a small sum of money, but as an example, if you know, right, Facebook's first external investor was Mr. Thiel, who acquired basically a 10% stake, put in about $500,000 into Facebook. This is back in August 2004. And guess, what happened on this $500,000 check, right? So Zuckerberg, when he listed the company public, it the exact some part of the stake that Thiel had, about 16.8 million shares, uh, were sold at the IPO by him for about $640 million. That is just part of the stake. Again, there was some part of the stake he sold at 400 million, and then again in 2016, little less than a million shares were sold for about 100 million. He still holds about a small 60,000 shares into Facebook. But if you really calculate all these exit values for Mr. Thiel, it's roughly about $1.1 billion. So a $500,000 check can result in an exit value of almost more than 2000x, which means a lot more in terms of percentage. So you could multiply your money, and this is just one example. Well, not all examples are as good as these, but you can definitely expect a huge outcome from startup investing. And startup investing in India now has come of age, and we are expecting this to grow multifold in the next 5 to 10 years, which is why you see this whole excitement about startup investing. So it's all about a game of aggregation, right? It's a power of aggregation that is at work. Aggregating investment dollars, right? You put money into the businesses, aggregating knowledge and experience, and then again, network of connection. How good is the network? How good is the connection between founders and investors? That actually does the whole magic. And again, you investing into various deals, a very high quality deal flow is very important. Where you go for your deals, where do you want to look into when you are startup investing, when you're looking at startups, where to get your deals from, where is the sourcing of the deal flow coming from? That becomes very important. uh, so that's all about aggregation, right? And while this is all very exciting, please understand there are a bunch of potential risks that basically all investors face, and I would just like to highlight some of them. Startup investing is a very risky asset class, right? Seed stage is even higher. So when you hardly know little bit about the company, when the founders have actually passionately started something, there are a lot of unknowns really out there, and that increases the risk. The more the unknowns, the higher the risk. It is filled with a lot of uncertainty. It's a highly illiquid market, right? Exits are not available so easily as compared to, again, I'm taking a example of stock markets where on click of a button you basically are out of your position. That is exactly what doesn't happen here. An exit has to be carefully planned, has to be orchestrated, very, very difficult to kind of execute that. Not too many opportunities come for exit, and you have to really take a call very importantly on how to exit. A lot of variables are faced by the startup, right? It could start well, something happens, somebody really overtakes the competition, that could lead to the failure of your startup that you invested. So a lot of untested ideas, a lot of unpredictability into the business. And early stage investing does rely a lot on the gut, so what your gut feels, based on whatever knowledge, information, intelligence that you gather. Eventually, something inside you basically tells you that this is a good deal or this is not a good deal, and that's what decides the future outcome of your startup investment. Again, India is still developing as a market. We are yet evolving, and a lot of things are happening as we speak. And you really can't follow as you would chase other asset classes like gold, silver, equity, for that matter, real estate. These are all very, very different markets. And so is startup investing. It's now emerging as an asset class. But again, a lot of things are unknown. So these are the just few of the risks that I thought we should outline, depending on what call you want to take, how much you want to invest. All of these things will go into the decision making, of course, knowing the risks. So that is exactly what I mean by risks. Of course, despite the risk, the rewards is, it makes it all worth it. And you've already seen a lot of stuff happening in India recently, right? In a manner of just 1 week or 10 days in April, we really saw 4 or 5 unicorns emerging in India itself. We are sitting on almost 30, 35 plus unicorns as we speak, right? And a unicorn is someone where the valuation is about $1 billion. So that's typically what a unicorn is, and that really proves the point that risk is 1x, however, and but the upside is unlimited. So while you could lose your principal, uh, entire of it, because if the startup doesn't really work out, whatever you've invested really goes down the drain. Typically, pretty much, I mean, most of the time, and that's why the success rate for some of these startups is quite low, and hence the risk is 1x. But of course, if it really works out, the upside is unlimited, and we'll see. I've kind of put down some examples in some future slides. So yeah, I hope everybody will understand why is the upside unlimited. And again, a venture capitalist, or for that matter, any early stage investor, is just as good or as bad as his her portfolio. Right? So while you may be very good in terms of analyzing everything, but your portfolio says it all, right? Everybody judges you by your portfolio. So if you have a good exit, if you have a fantastic outcome by way of exiting at a huge multiple, that typically talks about your ability overall, right? Because just a good entry point is not enough. The exit also is important. So how good you are making your portfolio, how diversified, how based on whatever thesis you have, is what actually defines you as an investor. So this is very important to note. Uh, and this is a very important point I wanted to make. Angel investors have to enjoy both, right? The process of investing, first of all, the diligence, uh, you know, deep dive into the startup, what they're doing, what are the vision, what are the plans, as well as post investing. So this is something called a pre-investing, and then the post investing. So post investing is, of course, now you've already put in the money into the startup, right? Now what do you do, right? You help them, you make introductions to them. uh, if they want a customer and you are able to get some few customers and they are able to scale up because of that, nothing like it, right? You are actually adding value to the customer, to the startup, because just putting investments and just watching from the fence really will not give you a optimum outcome. So founders always like investors who are able to help, who are able to add value to their business. And that's why something, a term that we have in startup investing is dumb money and smart money. So you really, all founders today nowadays are looking for smart money, and smart money comes with a lot of experienced investors. You've got to be an expert into some area where you're investing. Only then you can add value, right? Just because you like a deal, you may or may not get into the deal, because the founder is actually looking for something from you apart from just the capital. So that is something that I'm saying called adding value. So there's a lot of hard work that goes even after investing, knowing what the company is doing, where are the founders stuck, if they need some help in terms of business introductions, network connection, which I spoke about earlier in the aggregation slide. All of that, eventually forms your bond, forms your relationship with the founders who are basically starting the startup, right? So there is no instant gratification, so to say, right, that we have in this business. This will not, you know, it's like in stock market language, liya or circuit lag gaya. Nothing like that happens really in this business. For that circuit to happen, there is a lot of hard work that you have to do after investing. And after a lot of work, lot of interactions, a lot of hard work, a lot of networking, is when probably you will get a good exit. So there is, in short, no instant gratification that is available here. So having known that, let's understand what is the characteristic of a typical startup investor, right? You obviously have to have long-term view. You cannot have a short-term view, because the least amount of time that probably you will take for an exit is at least 3 to 4 years. So if you are thinking, okay, I will invest in a startup or my next year base dunga, so that will not happen. That typically is a bad strategy to go into when you're investing into startups. So a long-term view is important, because the value is created in the long term, never in the short term. So that is first. And then secondly, of course, a strong economic base. You need to have tolerance for risk. You need to have that capital, the appetite to kind of, be able to afford to lose the principal as well. So that's the tolerance for risk, tolerance for losses, tolerance for failure of the startup, which actually results into your failure of an outcome for a startup. So all of that, even temperament, it's very important how you deal with the founder, how you nurture him. Despite, I mean, all founders make mistakes, right? Everybody is prone to mistakes. Even you are, for that matter, when you're selecting startups, you would make a mistake as well. So, everyone makes mistakes. So it's very important how to deal with that failure. That brings the whole temperament issue. Right? So that is something that's very important, because remember, founders, where you support the founders, they will always remember, even if not in this particular startup, the next time they start something, after even they fail in the first one, they will always remember a good investor. And that is a very important point here. Strong people skills, how to deal with type A entrepreneurs, which are the superstars of tomorrow. You'll be able to identify, what are those skills. You will need good skills also to deal with these guys, right? Because nowadays we see founders from marquee institutes like an IIT or an IIM or any marquee institute. These guys have tremendous amount of strong skills, and takes a lot of discipline to kind of deal with these kind of founders. So also you would have to be willingness to learn, right? Not everything that probably you will know, right? The founder is doing something different. You will have to deep dive, ask those questions, learn from the founder to be able to understand whether you really can invest in this particular startup or not. So that's a characteristic that you guys as investors will have to develop, and over time learn. Willingness to learn is the most important thing. And of course, doesn't happen without any proper love or respect for the startups. Have respect for entrepreneurs. These guys are, putting everything at risk. Their lives, their careers, professional lives. They just give it up all for starting full time on a venture. So really, not it's something. It's an act of bravery. It's an act of courage. It's not easy to take a call to start a startup. So you have to have a great amount of respect and love for these founders and entrepreneurs. So those are some of the characteristics of a successful startup investor. And again, coming to the next one, there are various types of startup investors, right? You would think that fine, I'll see the idea, I'll see how it's good, and I'll invest. It's not as simple as that. One is, of course, there are four types that I could think about when you really want to categorize what kind of startup investors we're talking about. One is an opportunistic guy, right? Anything and everything interesting uh, is okay with him to invest. So, sector agnostic, pretty much can see everything. It is not limited by any bias. There is no bias, and that's why it's called opportunistic. The second person could be a type of investor who is very clear about his thesis, right? He's very clear that he wants a particular sector, he wants a particular area only because he understands that area much better. Because that's the reason why coming back to my old point of adding value, you can only add value if you really know something. You know about a sector, know about an expertise, know about a domain, even though it may not really fall exactly within the founder's domain, but something similar where you could learn from experience, like thesis driven. Either it's a like a social impact thesis, or anything that you might be close to your heart. That is something that you end up investing into because you are passionate about that, and the founder is also equally passionate. So if those things meet up, then typically it will give you good outcomes. You need to have like sector expertise, whether technology, media, telecom, healthcare, hospitality, travel, all of these areas, and industrial manufacturing. These are sector expertise that will define your investment thesis, right? And uh, you coming from that background, you have some exposure to it, will certainly help the founder, and that's the type of investing you typically will stand a better chance of investing and succeeding in it. Again, there's some like trend focused, right now there's a huge trend on crypto, though half the people don't really understand what crypto is all about. uh, People want to invest in crypto. People want to invest. I mean, of course, a lot of investments have happened in fintech, and we've seen a lot of large startups like edutech space, etc. So some are trend focused, like they want to capture the current trend. I'm going to make 5 investments, but currently, let's say there is one trend which is going on, so I'll capture that. I'll ride that, and then next year there is something else that comes up, and I also want to ride that. So you typically create trends, you follow trends very closely, and then you end up investing in that particular trend. So whichever startup is doing that particular thing, you will end up investing in that. That's called trend based investing. So this is the kind of various types of startups that probably emerge, and there could be more, but just as a broad category of types of investors. And again, you must have probably heard about pre-seed, seed, um, risk, associated with this stage. This is very important to understand. At which stage, at which round stage, which is the risk that typically comes in. So, for example, in a pre-seed, where typically pre-seed and seed is where you as angel investors probably would invest. There are basically two major risks: product risk, which is the main product, right? If the product is not ready, then the venture doesn't see the light of the day, and then that typically is a big risk. So, and then secondly, the team risk, right? So um, the founders, whether it's a proper team, whether something is missing in the team, those are the key two risks at very early stage investing. As you move on, right, business becomes a risk at a slightly later stage. And then again, pre-series A, which is a slightly enhanced stage where you probably are, the founder is raising a couple of $1 million. Execution becomes a risk, right? You've got the initial proof of concept, but you're not able to replicate that for a larger set of data. Again, scale is a risk for series A, growth is a risk for series B, and valuation, you have to protect your valuation going forward, which is a series C kind of risk and thereabouts. So it just gives you a little bit of indicative stage wise risk appetite that you should have, and you should evaluate these risks as they are very important at each stage. Of course, a lot of risks are interconnected. You could always have a product risk even at pre-series A stage, but what I'm saying is initially it's always a higher risk to have a product risk. That is typically, you will find this in most companies that you end up evaluating. Sorry, are there any questions so far? I just want to halt here to kind of ask if anyone has a question. Anybody, we can probably take it up, or if that's okay, we can take it up later as well. Anisha, Fayaz, anybody?
If anyone wants to ask the question directly, please use the raise hand option, or you may just type the question in the chat box. So maybe you can wait for a few
Sure.
seconds if any
Sure,
question
I'll
is there
wait
in the
here
chat box.
because we've covered something, so I just want to make sure everybody gets the context before we deep dive into future slides. Sure. So I'll presume that there are no questions. So we've covered a lot of ground in terms of what an outcome can give you what are the types of investors, uh, how do you invest, stage and risk so far, and we'll cover some more aspects of investing from here. Um, Sorry, is
Sir,
there a yeah.
there are a couple of questions in the chat boxes.
So can you just help me read out the question,
Yes,
Nisha?
sir. So the first is from Madhu Atre. What happens after Series C? Is there a Series D?
Yes, so absolutely. I just mentioned here as an example because Series C is where you are very advanced in terms of your life cycle. Obviously, Series D, E, even F happens before the IPO. The ultimate stage is typically an IPO, if at all. Otherwise, there could be various things happening before that. A lot of companies get acquired between Series A, B, C, etc. So anything can happen. This was just an example about a stage-wise series. So you could reach Series D, a founder could reach Series D, raise like almost $20 million in that Series D, etc. So the size of the round keeps increasing as the series goes up, and eventually you end up with an IPO where you probably are raising 1,000 crore or 2,000 crores. So that's typically. I hope I have answered this question.
So next question is from Mr. Ankur Pandya. How does one assess the product risk?
Yeah, so interesting question. Product risk is everything for a startup, right? You've identified a pain point, and I have covered something more in the future slide, but just to address your question, uh, everything is about a product, right? Everything that is scalable is a product. Any service, please understand, will not become scalable and eventually will not see through pre-series A and series A stages. It has to be a product which is scalable, which is basically low touch. Uh, like, let me give you an example of uh, probably a skin therapy meter, right? It's a small skin therapy meter. We just came across a startup which kind of deals with that. Now that product is, you can see the product in this case, but in some tech startups you can't see a product. It's a platform. So evaluating the product is very important for you to know, right? Whether the product really works. Sometimes what is being promised by the founder, what is in the minds of the founder, is not coming out on the product side. Like, customers cannot see it. So, and it's not working. It's good as a concept, it's good as an idea, but it's not really working. So something that is not able to work, something that you can't demonstrate to the customer, becomes a product risk. So just a small example of that. Any further questions?
So we may go ahead. There are no more questions.
Sure. All right. Okay, guys. So good. Between two types of investors. Am I audible, guys?
Sir, we lost last 20 seconds or so.
Yeah. So sorry about that. Um, am I audible now, Anisha?
Yes, sir. Yes, sir.
Yeah. Okay. Good. So just talking about investor mindset things, and basically two types of investors. On the left hand side are the ones who probably will not be able to invest because they don't have the right mindset. The other side is the one that you should have as an investor, right? So committed to being right. You can't be right every time, right? There will be occasions where you be wrong. And whenever you are being wrong, you have to admit it humbly, keep learning about it, right? You can't be defensive, you know, um, be headstrong with the founder saying, no, what I'm saying is right. And what the founder is saying is wrong. The founder will do something that he believes in, right? That's his venture. If you don't agree to it, uh, then you don't invest. But you can't impose beyond a point your thoughts into the founder's mind, right? You can be curious, you can ask questions, but learn how to be open. Don't be closed. You know and not everything will be a success. There will definitely be failures on the way, but that will basically teach you how to succeed. uh, and again, don't see the past and the present, see future. I already said about it that startup investing is all about understanding the future, seeing the future. Don't be opinionated, don't have opinions, constantly beliefs will change, right? As you grow, as you see more startups, your beliefs, your what you stand truly to believe might change as well. So just keep that mindset open to learn more and more as you go along. And as an investor, you basically interpret things, right? So when a founder is, let's say, saying there's an unmet need, I'm addressing that need. There's a market size, I'm giving a solution, which is a pain point, I'm trying to solve that. What you need to assess is whether this is going to be making money, whether this solution eventually will make money, even if not visible in the beginning. Is this business going to make money? Secondly, when the team is talking about themselves, their experience, their execution capabilities, and what they are projecting in the near future, you basically are hearing whether this is the set of founders who can make me money. Are they inclined of making this into a large organization, a large business house, which can make money for its investors? And then terms of investments, valuations, exit multiples, what the founder is promising is the answer to what how much money can you make. So first is there money to be made? Are these the guys who can make you the money? Is this the right team that can get you that outcome? And if so, how much can I really make out of this? How much can it be? Is it be a 10x opportunity? Is it a 15x opportunity? Is it a 2x opportunity? So that is something that you might want to just interpret as you go along. Again, so there are these two terminologies that you need to learn, right? Some of you must be already knowing it, but there is this primary round and a secondary round, right? A primary round is typically when investors invest the money in the company. They are putting their check in the company's account. The funding is happening in the company, like typically in all cases, most cases, to fuel growth, expansion, all of that, product milestones, all of that. A secondary round is somewhere at a later stage, happens much at a later stage, maybe in a pre-series A or a series A or B, where incoming investors are actually paying an existing investor to get out, right? To buy his or her shares in the company at a mutually agreed valuation. So this is typically called a secondary round. A secondary round is always between investors, and a primary round is always between the investor and the company. So I hope the distinction is pretty clear. And also by experience, we've understood that secondary rounds, when happen along with the primary round, like both can happen together, secondary round will typically happen at a discount to the primary round valuation. So just to give you an example, if a primary round, if an investor is putting in money, let's say at a 50 crore valuation in the founder's company, and if an existing investor is getting out and the new investor is buying some secondary stake, that might happen at a 10 to 20% discount to the 50 crore valuation. Uh, and why is that? Because the money is not really going in the company. The money is going actually to give an exit to somebody else. Uh, so that is the reason why you typically have a small discount to the primary round valuation. So I hope that is clear. And talking about exits, right? So how what all scenarios can come for your exit? So typically this question is asked by most investors to founders, and typically there are only three answers to it, and even the founder probably does not or not able to think about the fourth option, because there isn't any fourth option, right? Either you get an exit, like I just told you in the previous slide, right? On the secondary round, you basically exit when an incoming VC or investor is coming, and it gives you a chance to exit, which typically comes at a very good exit valuable multiples. Secondly, a larger company, a bigger company, more established, really takes over the startup, because it fits into their strategic intent. If they are also doing the same thing, they don't really want to build; they just buy out the stake, or the exit value here depends upon various factors. Attractiveness of the startup is important to the strategic investor. So it depends on what value is seen by the strategic investor. So that's typically your second way of exit. The third could be slightly more of a worst case scenario, where the startup is not really working out, things are going south, and the team is not able to scale. Whatever is left is whatever there's some IP in the company, there's some customers, something. You just try to make an exit, plan it along with the founder, you might just get your principal or some return back, or sometimes even the principal doesn't come. You probably will have to just write it off at a small value. At least the founder is able to work with someone else. Like they could be hired, like somebody hires the founder itself and gives you a small exit. But these are typically worst case scenarios, which quite in a basket of about 10 companies, it might happen to 3 or 4 of your companies. So that's typically how things work out. So these are the typical types of exit. I hope that is clear. To any questions on the type of exits?
Sir, not on type of exits, but we have a question. So, is it like if the startup we are interested in is not generating revenues, but we have an interesting product? So, is it wise to invest, and what are the things that we need to focus on while investing in such startups? Uh,
Sir, we are
we
not
can't
able to
hear
hear
you,
you.
sir.
Sir, we are still not able to hear you.
यज्ञेश सर यू कैन जस्ट क्लिक ऑन द अनम्यूट ऑप्शन, उसके बाजू में एक छोटा सा एरो होगा. जस्ट टेस्ट योर स्पीकर एंड माइक्रोफोन वंस, उस पर क्लिक करिए. मे बी इफ इट वर्क्स, एल्स यू विल हैव टू एग्जिट एंड रीजॉइन.
Yagnesh sir is joining back in a couple of minutes.
Yeah. Am I audible now, guys?
Yes, sir. Yes, sir. Now you're on.
Yeah. Sorry about that. I don't know what happened. So I'm going to quickly share back my screen, right? Is my screen visible?
Yes, sir.
Yeah. Sorry. What was the question? Sorry, Anisha.
Yes, sir. So the question was that if the startup we are interested in is not generating revenues, but they have an interesting product, is it wise to invest, and what are the things that we need to focus on while investing in such startups?
Yeah, well, this is a good question. So, a lot of these startups, at 100x also, people pitch to us, and we evaluate that. And sometimes they don't have customers, but what they do have is that a closed beta set of users who are still not customers. You should advise the founders whenever such an opportunity comes, whether they have tested it out, because the founder would have definitely tested it out at some point, right? So what they'll do is ask their close circle of people, and basically look at that and try to get some feedback. So even though they don't have customers, do they really have a use case? Is what you have to see. Secondly, if not, then you could maybe give some references for them, ask your references to use the product platform, and then see if the experience is good. At least it may not be a super or an awesome kind of experience, but it would definitely, if it's good, there is scope to improve, is what you can kind of try to assess the thesis, right? Whether this will really, with a few tweaks, with a little bit of improvement, with a little bit of work from the guy, this can really scale up. So that is typically a call that you take at that point of time. So that is how you typically assess startups which don't have revenue in the beginning. So that's a tough one. But the only way you can build your thesis is to ask more questions about the product, get a demo done. They will be happy to give you a demo. See the demo whether it's working, see whether they understand the problem. They are able to think more and say, okay, fine, these solutions I will add more as we go along. So try and probe founders, vision on the product. That will help you to even get some kind of comfort on the opportunity.
Thank you, sir. Sir,
Sir,
we
we
have
have one in the chat box.
Sure.
How much return does an investor have on series round exit, including discounted value?
Sorry, Faisal, you'll have to repeat that. How much return does an investor have on series round exit, including discounted value? I'm not sure what the question is, but I'm guessing what you're asking is that how much can I expect if I'm doing a round, let's say series A exit or a series B exit. It discounted value is a secondary round exit, is what I understand you're trying to ask. So let's say if the valuation will be determined by the primary round in most cases. So let's say the primary round is happening, as I said in the example, that let's say your primary round for the founder is happening at an X valuation, where some money is coming in at that valuation. Your typical discount will vary between 10 to 20%. It's all about your relationship with the founder. If your relationship is strong, he might be able to give you facilitate an exit at a lesser discount, which means higher outcome for you. So that 10%, if it becomes 5%, it's good for you because you get a better valuation for your exit. And in turn, you might add new income stream. So you revamp it. But let's say if it's happening after 3 years, then typically, sorry, is my internet working? All right, let me just check. Am I audible, guys?
so now you're audible. We just
Yeah.
lost you in
So a
between.
reasonable period for the angel investor to wait for the round funding to happen is, I mean, the journey of the founder is very important, right? When is he, how is he able to use the existing cash? When is he trying to raise the next round? Typically, a good growth journey leads a next round within a year's time. So let's say one round is done within the year, 18 months, he's ready to do the second round. That's typically how much you'll have to wait. Typically, for an angel investor, if you want to get out in the next round itself, it might take 18 months or might take 24 months at worst. But then you will not probably get that much of outcome. You might have to exit at a 2x or a 3x. Well, the potential of that founder could be much higher. So it's a very tricky decision to make at every stage. I hope I that kind of answers your question. All right, can we move forward? Guys, am I audible? Hello?
Yes, sir.
Yeah, guys, am I audible now?
Yes, sir.
Yeah, sorry about that. Okay, fine. So, let's move forward. Yeah, so, planning your investments in startups, how do you do that? So, you start by, let's say, investing small amounts. It could be anywhere between 5 to 10 lakhs per investment, one or two deals per quarter, or even 6 months if you feel so. Uh, about 50 lakhs or so, or even less, depends on how many investments you make per year. Keep some funds, we would advise to for the follow on investment. Let's say you like the deal is progressing well, the guys are up for the next round. You might want to add some more investment in a promising startup, the one that is really growing well. Then you actually double down. It's called doubling down of your investment. You basically put more dollars in that because he is winning, right? You actually back winners. You don't back the losers. You basically always back the winners. Put more money in a winning startup. Then you obviously look for your exit at either a Series A or a Series B, as we just spoke, or even Series C for that matter, if you're lucky. Uh, Try to stay longer in faster growing startups. That's how, like you really saw, the Peter Thiel example in Facebook. He just, sold some of the stake on the IPO straight away. Between the his funding and the IPO, there were at least 4 or 5 rounds, but he was able to stick around till the IPO, and that's how he got the outcome. Right? That's what is the lesson here. And then sometimes, exits may come to you. Let's say you are in a good startup, it's raising funds. At some point, there might be a forced exit. The new investor doesn't really want too many investors on the cap table. They might exit. There might be a forced exit, and in that case, it all comes to the negotiation of the discount at which you will exit. So, typically that's how you plan investments in these startups. That you're talking about, right? So one is the startup L, which actually is the red line, the startup K, which is the blue line, and the startup W, which is the green line. Uh, so invest in the flat, the stage where the company is flat, and right, and you double down basically when you start seeing this curve, when this the elbow curve happens, when the business is just beginning to take off. You put in some extra dollars so that you get a very good outcome when the company goes north, right? And don't invest here, unless you have tremendous amount of money, because that money will not grow at that multiple, right? The money that you invest in the flat curve or the elbow curve will grow much faster than if you really invest in the wall stage. So it's called the flat elbow and the wall phenomena, which kind of tells you how to invest, when to invest, and when to exit. So coming to some of the trends, some recent trends that we have seen is obviously there are some unicorns which are now applying for listing. You've already seen Zomato filing papers with SEBI for listing this year, and so there are other unicorns also which are following suit. SEBI has now relaxed norms for listing of startups, uh, and there are various tax and other IP related benefits that startup has. Uh, for like MSME benefits or DIPP registered tax holiday, income tax benefits. You're also now allowed to form a one-person company and allow it to be registered with ROC. This also will see good exits by investors, right? So that these are the recent trends that we have seen in startup ecosystem. Uh, and of course, if you really see out there, there are about 5,000 angel investors in India. Of course, half of them may not be active, but that still leaves a good 2,000 investors which are active right now, and that can give you the estimate of the number of scale that people are putting in, right? The landscape has very significantly changed in this last decade. The average ticket size has grown from less than 50, 100 investors a year back. The now ecosystem has almost more than 2,000 guys who have already invested in startups. So angel investing has really become a new asset class. The startup investing has become a new asset class. Family offices are now coming close, writing checks for startups. Uh, and angel investors are generally people who are, as you heard, right, that with great amount of expertise are able to help these startups, uh, and they basically don't have too much time in documentation, right? So coming to which kind of companies, and there's something to kind of add on to that first question I heard, and which kind of companies. Now here is where this might just give you a little bit of help in terms of what kind of founders you need to back, right? You want to back. You need basically a rock star team, because everything and anything today cannot scale without technology. So that is something that some element of technology scaling up you should be able to see. There has to be a very large market opportunity, and it should be a growing one. It also should have some kind of IP, some intellectual property, which kind of creates that magic around the startup or the solution. It should be something that people will buy, people will use. That is something that you need to validate. It's a difficult one, but you need to work hard on figuring out whether this will large amount of customers, large amount of users, will they really use the product? Will they really use the solution? That is something that you need to very work very hard to arrive at. And again, the business model, the revenue model, the pricing, whether this is really working out, whether this will really be acceptable. Again, uh, he should have that. The team should have an unfair advantage, or we call it the moat, to make profits, to make high number of users. Founders should have also put in some skin in the game, right? You can't have founders only living on angel investors or family money. They should be putting in something of their own. And it has to be a team with great amount of communication skills, right? If you can't convey your product, if you cannot convey your solution, you cannot convince investors, uh, you will not be funded. So that is very important. And the business should be hungry for capital. It should be hungry for investment to grow. That's a very important point, the seventh one. That is something that you need to keep in mind. So at 100x, we normally see these five things which are very important. We see the founding team, as I said, the market size opportunity, the unfair advantage that they have over competition, over the peers, business model strength, the pricing, the unit economics in case of a product, and then again a conviction that this could give us a minimum 20x kind of returns. These are things that we see as critical success factors, our investment thesis kind of, for all the startups that we evaluate. And also, we've seen a lot of these trends. One of the trends has been that more and more women founders have come forward, have started businesses, are brilliant outcomes. Investors have backed these founders. So, typically in our portfolio also, we've seen almost one fifth of the portfolio being led by women founders. And of course, seeded entrepreneurs, people with experience, it's always a good chance to kind of back that team, because they would have learned from the past mistakes, they would have learned from their past experience, they would have done fundraise earlier, so they understand how this works. So all of this becomes very important, right? Any questions at this point? Okay, so
Sir, we have one question in the chat box. Will you be explaining the application taxes on investment post exit? Sir, you are on mute. Is will you be explaining the application taxes on investment post exit? Sir, you're not audible. Just a minute, sir. You are on mute.
Sir, you're not audible. I'm not able to
No,
hear you.
sir.
Hello, am I audible?
Yes, sir. Now you are audible.
Yeah, I don't know. There is some problem. It's automatically muting me, and then I'm not able to unmute. But anyway, I think we'll just progress. So yeah, sorry. What was the question? While I just bring on my presentation.
Yes, sir. So the question is, will you be explaining the application taxes on investment post exit?
Taxes, I'll deal with it very shortly, though I don't have it covered in my presentation currently. But I'll talk about that in a bit.
Okay. So we have one more question. That is, how can I evaluate business strength? What metrics are used? No, sir. We can't hear you. Not audible, sir. No, sir.
Metrics, you mean? I mean, so if the company is doing revenues, then you might depends on various things. Metrics are different for different businesses. A B2C, a B2B will have different metrics, right? A B2B will be more important as to how much is the sales cycle to close the business, what are the margins there. A B2C will be more user driven metrics, right? So how many users are on the platform? If it's an online e-commerce business, what is the user retention? What is the daily average user if it's a platform or if it's an app? Those are things that you see, right? Different metrics are used for evaluating B2C as well as B2B businesses. So it depends on that. Every business has its different unique characteristics to be able to measure, the key metrics, and that kind of differs from business to business.
Okay. Sir, we have
Sure.
one more question. What are good crowdfunding platforms for Indian investors? Can an investor participate in the same and get some stake?
Uh, so there are a lot of angel networks, if you know, right? So what is happening is there are various networks like an Indian Angel Network, or for that matter, Mumbai Angels. There are various angel networks which are there, which you can become a part of, and that's how you could end up investing. So you have to invest, confirm your. They will show you the deals, and you can choose which deal is getting subscribed, and then you partly join the deal. So an initial evaluation is done by a lead investor in most cases. Once a lead investor evaluates a deal, and there is a lot of interest, you could just co-invest. You could join in basically. So that is how typically networks invest. Crowdfunding is not really very common in India, but yes, network investing is. A lot of angel networks are out there. You could just join any of these networks. There is a small fee to join the network, but you will get access to deals through the network.
Thank you, sir. Sir, we have one more question. So, how much equity should I ask from startup during seed rounds?
Well, seed percent depending on how much check you're putting, how much of the round is the founder raising. So there are various parameters, but typically a seed round dilution for founders will be anything between 10 to 20%. Typically how this works. Again, differs from case to case. I hope that answers your question. All right. So I think I'll try to share my screen. I hope it doesn't really mute me out again.
Yes, sir.
Okay. All right. So we were on this slide, right? I'll just try to go forward. Just tell me if I'm audible, Anisha.
Yes, sir, you're audible.
Thank God. Okay. All right. So well, we were at the critical success factors. Yeah. So some of the reasons that these startups fail, right? Most startups fail because of these 10, 12 reasons, right? They're not the right team, not the complementary skills, runs out of cash pretty much, start spending some initial seed money that they get. There is really no market need. They feel, the founders feel there's a need, but actually there isn't. So that is something of a problem again, that happens. Uh, uh, Sometimes founders don't have complementary skills like business, tech, financial skills, or product design. Those kind of skills are not really complementary, and this creates a problem. When the company starts growing. So unless you have the right team, and a single founder, that is why becomes daunting of a task. The guy cannot do everything once the company starts scaling. So either you hire good team members, give them ESOPs, make it happen, or get the right founding team. Again, sometimes you get out competed. You don't have good economics, right? Unit economics is not good. Gross margins are, in case of a product, are less, or in case of a platform, you don't really have that many users. You're acquiring users at a much higher cost than what the user is paying you. So poor unit economics, unfriendly product, very bad experience on the product, right? The poor marketing, you are not able to showcase your marketing on a, let's say, a social media or whatever are your channels that you are using to promote your product, and you are ignoring customers, right? Customers' request is not being met. Uh, Customers asking you to, give you solutions and ask solutions, and you are able to provide. So these are some of the reasons why startups fail. And again, typically there are four stages of a startup, right? One is a prototype, like very initial stage where small checks are required. But what essentially the founder is trying to do is basically trying to use the type of product or service for customer discovery purpose. So the prototype is basically customer discovery. You are trying to find your first couple of customers. The MVP stage, which is the minimum viable product stage, is basically a stage which is used for customer validation. You first discover the customer, then you validate with the customer whether they will use the product or not. And this is exactly where the seed stage funding should really happen. After that, it's growth capital, and Series A, B, etc. comes in. You find your product market fit. A product market fit is a stage which is used for customer creation. You have more and more customers. Beyond the initial set of customers, you are able to get more and more customers, and you are acquiring customers. You're putting Salesforce, you're putting all your in-house team to get more and more customers. As you keep finding your market fit amongst the future number of customers. And of course, the last stage is, of course, the growth and the scaling. You already found your wow moment, wow product, and people are demanding that more and more. And it's time to just pump in money to just scale your business exponentially. So that typically is the fourth stage. Coming to better numbers, I don't know, most of you might know this, but I just thought this is good for you to start off with. So let's say you are putting in, bunch of you together are putting in, let's say, 2.5 crores in a company, and you are valuing essentially the company at 10 crores, putting in 2.5, and you are negotiating a 20% stake, right? So how does it all work? So 10 crores is the pre-money plus the investment amount gives you the post money typically, and this is on a fully diluted basis post financing. So a 2.5 crore check divided by 12.5 gives you the 20% ownership. That's how ownership is arrived at post money. Always, it's never pre money. It's the stake that you get is always post money. That is just a small example of how it happens. And this is, I think, the next slide is an example of, I think most of you guys probably are asking this question, how much the founder dilutes. You should always think about how much founder dilutes at each stage, because if the founder is not left with enough stake, then he basically will not be interested in running the business. So you have to make sure that till at least Series B stage, where he raises about 50-60 crores, he's able to at least, or the team is able to at least hold 35-40%. If that is not happening, and if that is number is coming down because investors are getting more and more shares, the founder will typically lose the motivation or the incentive to grow the business, right? So, and the way this happens is, initial first stage, as I said, right, 10 to 15% seed stage, angel stage another 5-10%, Series A aate, it's like for 35-45%, and then you dilute 60%. The percentage down below is founder stake I have mentioned. So initially they own 100%. By the end of Series B, you typically come back to 40%. The founders will be owning 40. Investors will typically jointly own about 60%. And the way this whole table works is I've just demonstrated by way of a table. The fundraise, the dilution, the percentage dilution that founders goes through, and each investor goes through, right? The minute first investor comes in, with the amount of the second investment, the first investor also gets diluted. So that's how the dilution typically works. I hope are there any questions on this particular slide, because this is an important slide for you to understand the numbers. Anisha, Fayaz, any questions?
If participants have any questions, you can drop in the chat box, please.
Yeah, this is the dilution that founders undergo at each stage, right? So that is how the math will work going forward in each round.
Sir, Mr. Sudarshan asks that are these exit values?
This is the infusion on the top that you see, right? This table shows infusion. So 1 to 2 crores, 15 to 20 crores infusion in the company. And this typically shows the post money. The post money is always the pre-money plus the fundraise. So this is not the exit. This is the valuation for everybody in the game. Right now, let's say nobody is exited, but the angel investor is actually making 17x after Series B. This demonstrates that, right? Whatever check he put in is worth this much, 17x. That is what this table shows. How is value creation happening for each level of investor? And you could exit, might as well, to just answer to the same question, you might negotiate a secondary deal here, right, with the Series B investor, and you could make your 17x, some discount on that, at least 14-15x, and get out. This is the piece that I was telling you about earlier. Is that clear? Any other questions are there?
Uh, Sir, no more questions, so we can go ahead.
All right. So, this is all about the angel investing I wanted to talk about. But, more importantly, we at 100x, as you know, right, we invest through iSafe, which is a very simple document. There are no long agreements like a shareholder agreement that some of you might have seen. So we invest through iSafe, right? So iSafe stands for India Simple Agreement for Future Equity. This is a convertible instrument through a CCPS, right? Compulsory convertible preference shares, and this is relatively very suitable for early stage investing. So we had basically introduced iSafe notes in India for the first time in 2019, and by now, as you know heard initially in introduction, we've already invested into 50 companies so far. The benefit of iSafe notes for early stage investment is that you don't really have to value metrics. Yet you are at a convertible, you are on a valuation cap, so you really are not fully valuing the company. You are coming on in a convertible. The execution is fast. It's a simple 5-6 page document. It's available on our website as well. Uh, so that takes simply 2-3 weeks to close rather than an SHA round, which is typically 2 to 3 months. And funds are needed for the business by the founders, and not compliance costs. You don't have to really spend on too much on lawyers to draft the agreements, etc. So iSafe note is a standard cookie cutter document here that you can use. So key features of iSafe notes is that it's a high resolution financing document. It's a one security document, and also in India there are CCPS issues that we have to do. So it typically is a contract backed by a security. And you would be thinking, what is in it for angel investors? So angel investors can cut deals with founders much faster with iSafe. So while VCs take time, they do a lot of diligence. You could just analyze the deal, invest fast, sign in iSafe, typically invest faster, and then you can beat actually the other angels as well by quickly closing deals with the founders. So founders are, we've seen our own portfolio companies raise money from portfolio companies, from our investors. Almost 300 odd investments were made in our portfolio companies in the last 2 years, uh, and that keeps on continuing with every class. So I have just put here the expected date for class 5. So some of you who are interested to look at the pitch day can register for the event whenever we announce that. um, yeah, and we really feel, and by the way, the ISAF document is there on our website, ready document. You can go through that. If there are any queries, I'm happy to answer that. We really feel ISAF is the most powerful tool that will transform the way the early stage funding takes place. And we have seen micro VCs, family offices, individual investors invest through ISAF in our portfolio. So that is what is we have seen in the last few months. And I just, and that's the last slide. And I again thank the PDPU IIC team. Happy to take any questions if there are any more.
Yes, sir. Thank you, sir. So